Hello everyone. Welcome back to our channel. Today, we're diving into the changes in accounting policies as per IAS 8. We'll break down the principles and provide practical examples to make it easier to understand. Let's get started. Changes in accounting policies refer to adjustments made in the specific principles, bases, conventions, rules, and practices used by an entity in preparing and presenting financial statements. In simpler terms, this means that when a company decides to change how it prepares its financial statements, it must follow certain guidelines. For instance, if a company switches from the straight-line method of depreciation to the declining balance method, this is a change in accounting policy. An entity should change its accounting policy only if the change is required by an IFRS or results in the financial statements providing reliable and more relevant information about the effects of transactions, other events, or conditions on the entity's financial position, financial performance, or cash flows. Practically, this means that changes should not be made arbitrarily. For example, if a new IFRS standard is issued that requires a different method of revenue recognition, the entity must adopt this new policy. Alternatively, if the new policy provides more accurate and relevant financial information, such as using fair value accounting for investment properties instead of historical cost, the change can be justified. The following are not changes in accounting policies: application of an accounting policy for transactions, other events, or conditions that differ in substance from those previously occurring, and application of a new accounting policy for transactions, other events, or conditions that did not occur previously or were immaterial. For example, if a company starts engaging in a new type of transaction that wasn't previously encountered, applying a new accounting policy for this transaction isn't considered a change in accounting policy. Similarly, if a previously immaterial transaction becomes material, applying an appropriate policy isn't considered a change. Subject to practicability, a change in accounting policy should be applied retrospectively by adjusting the opening balances of each affected component of equity for the earliest prior period presented and other comparative amounts disclosed for each prior period as if the new policy had always been applied. This means that when a company changes an accounting policy, it should restate prior financial statements as if the new policy had always been used. For instance, if a company changes its inventory valuation method from FIFO to weighted average, it should adjust the inventory values in the financial statements for previous years to reflect the new method. If it is impracticable to determine the period-specific effects or the cumulative effect of the change, the new policy should be applied prospectively from the earliest date practicable. Sometimes, it might be impossible to restate past financial statements accurately. In such cases, the new policy is applied only going forward. For example, if detailed records are not available to restate inventory values for past years, the company can apply the new valuation method from the current year onwards. When an accounting policy is changed, an entity must disclose the nature of the change, the reasons why applying the new accounting policy provides reliable and more relevant information, the amount of the adjustment for each financial statement line item affected, and for basic and diluted earnings per share for the current period and each prior period presented, the amount of the adjustment relating to periods before those presented, if practicable, and if retrospective application is impracticable, the circumstances that led to that condition, and a description of how and from when the change has been applied. In practice, this means that transparency is key. When a company changes an accounting policy, it must explain what changed, why the new policy is better, and how the change affects the financial statements. For example, if switching to fair value accounting for investment properties, the company should disclose how this impacts the balance sheet and income statement, and provide details for both current and previous periods if possible. Understanding the changes in accounting policies as per IAS 8 helps ensure transparency and reliability in financial reporting. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more insightful content. See you next time.